Hi, this is Mike Maloney with my take on gold for June 6th, 2016. On Friday, there was a jobs report that came out that was absolutely abysmal. Tiny addition in jobs. On that jobs report that came out on Friday, gold made some huge advancements here. It went up big. It's not the biggest. There have been other single-day advancements that were one bigger. This is only a 6 months chart. So this goes back to the beginning of last December. It's a few days more than 6 months. I wanted to make sure I had included the December lows in here. So this was the reaction to the jobs report. But when I took a look at the chart, I found some things that were very interesting. I like to look at things in a historic time frame. I want to get the big picture of what's going on. This is the move that we're talking about that happened last Friday. Now, a lot of people hail this as that the gold bull market is back on, and I think that we may be in the gold bull market, but I also think that there's a very good possibility that we could have one last big pullback. Now, one of the things that you want to pay attention to, there's two lines on here, the 50 and the 200-day moving averages. And so the blue one is the 50-day, the red is the 200-day, and what you see if you look historically is the 200-day moving average oftentimes acts as a long-term support, and then that 50-day moving average acts as a short-term support and a short-term resistance. You can see how it supported the price right here. You can see it supported the price right there, again right through here. And then when these cross over and the blue goes below the red, this is a bearish alignment, it's called, a negative alignment. When the blue is above the red, that's a positive or bullish alignment, and is one of the confirming indicators that says whether we're in a bull market or a bear market. And the alignments here became bearish back in early 2013 and stayed bearish except for a couple of little whipsaws until just this last February. And then we've had this big bullish move, telling people that we're back, the bull market is back on. But one thing I look at here is that the 50-day has become resistance many times. It sort of caps the price of gold. And then when it turned bullish again, you see that when we do this close-up, it supported the price of gold. It was a very good support area. So that was April. The 50-day was acting as support. We broke it decisively toward the end of May. Now we're back up to it, but it's acting as resistance. So we've got to see, does this get back up significantly above the 50-day? A little tiny bit above 3% or so doesn't really count. It has to get significantly above it. But what this has caused is a bunch of the stock promoters to jump out there and beat the drum. And there's a bunch of really good stock analysts out there. And then there's a bunch of people that tarnish their names. There's the pump and dumpers, the scam artists out there that will accumulate microcap stocks very quietly. They buy them very slowly so they don't push the price up. So they pick a stock that has a very small stock float, not a lot of shares out there. They buy it up, and it's something that's at a low price. They buy it up slowly, and then they write a newsletter or come out with a video proclaiming how great this stock is, and their subscribers purchase the stock goes up, and then the pump and dumper is selling into that rally and makes a whole bunch, but basically he's taking money from his subscribers. That's how he's making a living at it. Personally, I think it's despicable. They also call it front running. So you want to stay away from these guys, and you want to look at people that have a very long track record. People that you can go back and take a look at their stock picks and how well they did for the months after that, not the days after that, but months and months. And when that stock analyst issued a sell signal on that stock, was it bought and then sold at a profit or not? But so looking at the stocks, I'm going to take a look at a couple of stock indexes where they're sort of averaging quite a few individual stocks and putting them into this index. This is the Dow Jones Gold Mining Index. It only goes back to the year 2000, but I've stretched this chart back to 1980 because I'm going to present several stocks, and I want all of them to be on the same time frame so that you've got a good orientation here of what's going on. But what you see here is that the stocks starting in late 2000 went up and did a tremendous rally from under 30 to about 150, but then pulled back and came back to basically 2001 levels. Now they've made this tremendous leap up. This is more than a double. We've gone from under 35 up to 75. So that's some spectacular performance for just the first. We're not even through half the year yet. And in just half the year, these stocks that are in this basket have collectively doubled in value measured in US dollars. However, I like to take things into gold and see how they look. It looks very, very different when you price them in gold. And what you see here is that the entire rally, where we're at right now is you were much better off selling these stocks back in the year 2000, 2002, 2000. If you had sold in 2004, that was the peak. This index would have been worth 1/4 of an ounce of gold back then. Today it is worth 0.06 or 55 roughly. Now, going back to the index measured in dollars, you have to look at these up legs and the size of this up leg, which took more than 6 months, and this up leg. We've just had an up leg that's as big as any of these, which suggests to me that the up legs on stocks may have already exhausted themselves. And then measured in gold, this is the biggest up leg that we've had. And so, again, that's saying that these up legs in the stocks have exhausted themselves. Now, when you buy a stock versus buying the underlying asset, you introduce other risks. This is the Dow Jones Gold Mining Index, so it tends to be larger stocks, not these microcap stocks. The smaller the stock is, the riskier it gets, but the more opportunity there is for the upside. So I really benefited from some microcap stocks back in 2003, 4, and 5, and I'll tell you more about that when I present some other charts later in this presentation. But stocks introduce this risk of things like bad management, a mine collapse, an EPA shutdown, a labor strike, and then if it's a mining operation that's in some politically volatile company, nationalization. This has happened many, many times in the past to stocks, and in some instances, bad management and such, and nationalization, you lose everything. So a mining stock can fall to zero. Gold, the underlying asset, can't. Now I'm going back a little further in time. The Dow Jones average went back to the year 2000. This one goes back to 1996. This is the HUI Gold Bugs Index. It bottomed and started rallying in late 2000 and rallied up and had some spectacular performance where you're talking about going from under 50 to over 500. So you're talking about 10 times gains here. But again, we've just seen one of the biggest rallies in the shortest periods of time in this entire, it's a rally that is the equal of these rallies back here and this rally. And this rally here took a much longer period of time. But divided by the price of gold, and this is what the performance looks like in gold. Now, I was lucky enough to buy a bunch of mining stocks around April of 2003, and I caught this last final up leg. And I saw some spectacular performance from some gold stocks. There was one silver/uranium play where the mine had both uranium and silver, and I saw that stock peak out at 40 times the price that I bought it. Now, I actually didn't sell at 40 times. I sold a little bit on the way up and a little bit more, and I sort of dollar cost averaged out of this stock. And I sold some here, and I think I did this study in 2010. So I sold all the rest of my mining stocks here, and I avoided the rest of this huge down leg. Again, we've had this spectacular up leg in a very short time, but let's go a little bit further back in time. Here we go back to 1984. This is the XAU, gold and the Philadelphia Gold and Silver Index. What you see here is that this thing just noodles sideways throughout time, bouncing up and down, and the volatility is now increasing. These swings are getting larger, but basically it's going nowhere. Right now, it's at the same levels that it was at back in mid-1984. So if you had invested in 1984, your stock measured in dollars would have gone nowhere, and if you adjust it for inflation, you have taken enormous losses. But let's divide it by the price of gold and see what's happening. Well, the peak was actually back in 1996, and it has been falling ever since. And again, this is one of the biggest up legs that it has had in its history. So that's probably exhausted. So my point here, I was talking about in the jobs report and now gold. Be your own central bank. That's what I have done. Now, I don't make recommendations. This is something you could do if you want. Personally, what I have done is I had a core position of gold and I had mining stocks for the leverage. I was lucky enough because I just happened to study these the Barron's Gold Mining Index, which goes back to before 1971, but I took it from 1971 when gold became freely traded and when Bretton Woods ended, when Nixon closed the gold window. I took it from then until today, not today, but when I did the study a few years ago, and I found that gold had outperformed the Barron's Gold Mining Index by 400%. And what that means is that the gold mining shares give you leverage on the way up, but they give you even bigger leverage on the way down. And that's the reason that over time, all of these things, I mean, if you look at the Dow Jones, you see losses that are on about the same level. What it shows is that with all of these, that gold will have over a long period of time about 400% better returns than the average of these stocks. However, pick the right stock and you do spectacularly well. I saw that happen to myself. I consider it more of an accident. Also, the mining shares, these companies, especially the small ones, they tend to be the greatest inflators in the world. They issue more shares than the Federal Reserve issues currency. And so they dilute the purchasing power of each share. And that's one of the reasons that the XAU went nowhere since 1984, and then measured in gold, it's been going down since 1996. Here's another way of taking a look at these things where I'm not dividing these prices into each other. Right here you're seeing the performance of those stocks against gold. But here's another way where I've done what's called a performance chart, and this is simply a percentage change this goes back into the year 2000, so this is basically this century. And the blue line is gold, the red line is the Dow Jones Gold Mining Index. Which one would you rather be invested in? The gold that doesn't carry the risk of a mining collapse. If you buy 100 ounces of gold today, it's going to be 100 ounces in 10 years. It's not going to disappear. Where a stock, if you have bad management or nationalization or a mining collapse, that company can go to zero. It can go bankrupt. And then here is the XAU compared to gold. Again, which one would you rather be in, gold or the stocks? So with central banking, it used to be that our monetary base was gold, and then there were paper certificates called gold notes issued on top of that monetary base, and then the banks would further expand the monetary supply through fractional reserve lending. So it's a pyramid that's pyramided on a base of gold. And if you look at the commodities exchanges, the futures markets, those are all pyramided. They've got an underlying asset, and then they issue paper certificates. So it's paper pyramided on top of gold. Well, gold mining stocks are the same. They are certificates. They're claim checks on a company that produces gold. So the underlying asset is the gold that they've got in the ground. The certificates that you trade are shares of the ownership in that company that owns the gold in the ground. But if you want to be your own central bank, what I have done is a core position in gold and silver that was the majority of my holdings, not the minority. And then I had gold mining stocks. I got rid of them before these big down legs in the stocks, and I am so glad that I did. And there will come a day when I start buying stocks again, but I'm not absolutely convinced yet that we aren't going to do some more chopping sideways in gold, or that it could fall a little bit more. I believe that there's a big deflation coming. That jobs report was a confirmation to me that the recession that I've been predicting for a while now, that we are actually in it. And you've got to remember, recessions are a trailing indicator. You need 2 consecutive quarters of economic contraction for them to officially declare that you're in a recession, and that means that you were in that recession for the past 6 months or more. So what I've done, again, I checked out of this paper Ponzi scheme many years ago and went into where most of my wealth is held in gold and silver. I don't care about these temporary gyrations. I believe that gold and silver come with a central bank guarantee. The guarantee is that they will never stop printing currency. All central banks on the planet will continue inflating their currency supplies. And when you measure the number of units of currency that exist compared to the number of ounces of gold that exist, the currency is always growing at a much faster rate. And that means an inevitable repricing, where gold is priced in many, many, many more of those units, not necessarily because gold went up, but because the currencies went down. Thank you very much for listening. If you got anything from this, please like it and share it, and we'll see you next time. Thank you.